Oh, that's a lot of Raghee. Good morning, gang. Hope everyone's doing great. Let me get some screen going. Welcome to my slightly messy office. We are in the process of moving to a new office. So there we go. Woo, that was a lot of me. I'm glad my hair and makeup team was here to take care of everything this morning. Yeah, right. Great to see everyone. Happy Friday, gang. Hope everything is going well this Friday morning. We do have one more FOMC speaker on tap before we go into what will presumably be the blackout period before the FOMC's meeting on the 20th. So usually they just shut up in terms of the messaging about monetary policy. Now, in the meanwhile, there's been a lot of volatility, and no better. There's two big lessons from this week. I want to make sure I share with everybody, since as we kick off the show, of course, as always, if you have any questions, feel free to type them in. Symbol, time frame, indicator, question. Go for it. But if there's anything that's really been a great takeaway from this week is two things. Number one, keep it short term. Let me give you a great example of a loss. I'm going to give you a great example of a loss. Okay, Rog, how do you be a good winner? And how do you be a good loser? And which one's the most important? It's the latter. It's being a good loser. When we have something like Apple that was sinking into a really nice support zone, 200 daily price movement range, but it's not quite holding as we go into the close. One of the things that we did in the Sector Secrets Mastery, we took a very small position at a conservative level. So we got a really good price. But then we realized price just wasn't holding. So let's talk about what we did not do. We did not defend. We did not add, file all that under things that losing traders do. How about we just not stroll down the river of denial and say, look, it's okay to be wrong. Let's be wrong quick. So we got out of Apple and we were looking for some support. Now, then comes the news about Apple, and it gaps down. This is why we don't overstay a welcome. So were we stuck in the gap? Nope. We took a tiny, and I do mean infinitesimal paper cut. It stings for a moment and we move on, right? Really, really important. So yeah, that was one of the examples of a loss. Now, I don't mind talking about losses because, like DJ Khaled, I win a lot. Now, let's talk about where we're winning. Where are we winning? Right now, we're winning on short-term time frames. So Tuesday, we went to the overall approach of, hey, how can I trade today? The today trading I've been talking about for weeks here. In fact, the class is coming up tomorrow. If you haven't already checked it out, we're going to be going live with that class Saturday morning, and you can catch it all over at simplertrading.com/clarity. Now, for those of you that have been wondering, Rog, how do I get a hold of the hourly price movement ranges? How do I get a hold of all the different indicators that you use, that whole day trading package? This is the best way to do it, gang, because when we have a class, we stack it with all the things that you are going to need to do the kind of trading that you're going to do with the kind of lessons and the examples and the strategies that we're going to outline in the class. simplertrading.com/clarity. All right. So where's the clarity? 5-minute time frames, short-term time frames. And so this week on the day trades, we went 3 for 4 on Tuesday. So I think of trades as at bats in a ball game. Went 3 for 4 on Tuesday, because Monday, of course, was the bank holiday. Went 1 for 2 on Wednesday, and we went 2 for 2 yesterday. So usually I'm going to average 2 to 4 day trades in that morning, which is my favorite. There are opportunities to scalp in the afternoon or any kind of momentum. That's going to be part of the class. And that's going to be a bonus session, by the way, that the Lorna bot is going to be doing. And there are opportunities in the afternoon, but the prime time is between the bell and about 10:35, maybe moving into 11:30. So it's a pretty tight time frame where you can find opportunity. Well, that's where all these trades came from. So we had a really good productive week of day trading. Why? Because we're still very volatile, but still very choppy. And that is ideal fertile ground for short-term trading or today trading, right? What's happening today? Let's trade it, right? Today the market's up, great, let's get long. Tomorrow the markets are down, great, let's get short. There is no other type of time frame or time horizon that's going to give us that flexibility. So that's the lesson here today. And if you are going to be taking overnight trades, like we tried to do with Apple, keep the paper cut levels in mind. Don't risk, don't add, don't defend, don't do all those things that presume an overall trend, because that is not the environment we're in, right? As we go into the latter part of 2023, we're not sure what the Federal Reserve really has up their sleeve. Until Jerome Powell wants to give us his S&P target, we have to speculate. And in that confusion comes the chop. All right. So as always, let's go ahead and dive into the best part of our show. And that is your question. So let's open these charts up and kick it off with Alex, who asks 5-minute hourly price movement ranges, almost overlapping from 4 to 5. It's just higher than normal volatility, Alex. That's all. Sometimes there's a catalyst that's on the schedule and sometimes there's not. But that's okay. The indicator is going to make sure, you can see right in there, the indicator is going to make sure you're at least aware of the fact that this is a more hazardous territory. So great observation. HPMR is doing exactly what they're supposed to do, which is protect us from environments that are not in that sweet spot of the 68% probability. All right. Next up is, let's see here. Bear with me, gang. Scroll down through the questions. If you have any questions, gang, type them in. Alex, all right, cool. Okay, we have some questions from our essentials room. Good morning over there. PM asks, can I use hourly price movement ranges, HPMRs, on dailies? PM, no. And here's why it's a no, right? Here's why it's a no. When we calculate HPMRs, we go back, we have a custom data service, a custom curation of the data that we use to calculate my HPMRs. So that's a big part of what the bot does. We update these about every 2 to 3 weeks. So A, they have to be updated. B, how are they updated? Okay. When I'm calculating at hourly price movement ranges, I'm looking at hourly breakdowns going back 6 months. Hourly breakdowns are going to be ideal for anything that's really under 60 minutes in terms of the chart. If you start applying a really short understanding of volatility to a really long-term chart, it's going to be out of alignment. That's why. So HPMRs are for day trading, short-term intraday, and daily price movement ranges are for overnight exposure, where we're looking at an entire session's volatility. So if I were to tell you the volatility between 9 to 10, 10 to 11, 11 to 12, right? You'd say, oh, okay, those are smaller, narrower volatility patterns. You look at the entire volatility for a Tuesday, it's a very different beast, right? So that's why we use hourly price movement ranges for day trading and daily price movement ranges for swing trading. They're two very different curation of the data. It's two very different outputs. All right. So I hope that makes sense. And yes, while it's tempting to want to use them on other time frames, remember, please use the right tool for the right job. And if you find yourself wanting to swing trade, here's what I'll tell you, gang. And I say this as the class is coming up. You know, when we have classes, we try to put everything you need. So those of you that, say, for example, took the elite on the class, what you've got is a year of the mastery, the entire class, the bonus sessions, the entire day trading indicator package, and a year of hourly price movement ranges. So if you were to separate all that out, I want to say it's somewhere north of, right around, I don't know, somewhere north of $5,500, if not more. I'm probably on the low end of that. So we try to put a lot of value in that class. You get the class, a year of HPMRs, and a year of the mastery. So, you know, if you find, okay, Rog, what's the best deal? Because I'm trying to I get it. I don't want you to have to spend a lot of money on all the indicators either. Which is why I always tell folks, wait for a class. We're going to make sure you have a killer deal. So PM, I could appreciate that. And so when we did our swing trading class earlier this year, one of the packages was an entire year of updates of the DPMRs. That's why I mentioned this, gang. That's why I get so excited for the classes, because we do put a lot of value in them. All right, next up, how often are they updated? So daily price movement ranges are updated about every 3 to 4 weeks, because if you over update them, they become inaccurate because they're too sensitive. If you are too slow, then they become inaccurate because they're too slow. So Lorna Bot and I keep an eye on what's happening with the expansion and contraction of volatility. That's really, really important. So DPMRs are about every 3 to 4 weeks, or every 21 to 28 trading days. And HPMRs are about every 2 to 3 weeks, every 10 to say 15 trading days, right? Or 2 to 3 weeks. So we're always monitoring the expansion and contraction of volatility. And that's when we put out the new HPMRs. And speaking of that, new HPMRs went out Tuesday of this week. So we've got fresh HPMRs to kick off our fall day trading season, reflecting the kind of volatility. We've seen some volatility, right? Reflecting the kind of volatility we saw at the end of August, right? And so with that accuracy comes the confidence to look at the green zones and the red zones, to look at the yellow zones and the gray zones and know, all right, this is in alignment with the behavior that we're seeing. So it depends on, so HPMRs are a little bit more often than DPMRs. Yeah. All right. 305 News asks, please explain what part of the macro kept me long the market starting January as the Fed threatened to raise rates at each meeting. So 305, two things kept me long. The first thing is, well, let's go to the daily time frame and I'll show you. So first of all, please remember that in terms of our lizard brains, which we all have to deal with, fear-mongering works. It's far easier to talk about big drops, how the market's poised to tank and everything else. That just gets attention. I will tell you, I think about this a lot. Who's seen Tom Lee on CNBC before? Who's seen Tom Lee? He's on there all the time. He's always bullish, and everyone makes so much fun of him. He was bullish in the sell-off with the pandemic. He was bullish in the recovery. He's typically bullish. He's looking at the macro and saying, hey, look, this is what's happening. And yet, you think about sort of the jaded folks out there saying, oh, the inverted yield curve and the this and that. None of that's panned out. So what is macroeconomics? Macroeconomics is not a big lens view. Macroeconomics is the rate of change, aka the trend, of inflation, of jobs, and of growth. Those three things. Google macroeconomics. Just Google the word and you'll see there is a definition. So if someone says there's no definition for macro, they have no idea what they're talking about. There is a definition of what macroeconomics is. And it's measurable. So we don't have to speculate. We don't have to fearmonger. Number two, by the end of January, 3 weeks in, we are already starting to see price action get above the 200. If you're not looking at where price is in relation to the 200 EMA, please add that indicator, or even better, add the simple propulsion. Okay. This is a free indicator, right? I give a lot of my indicators away for free. This is one of them because it's a needle mover. By the time we got to April, we had tested that level twice. So if you were still thinking we're very choppy the beginning of the year, the first quarter, you're right, but it was chop favoring bullishness. Take a look at my multi-trend, yellow neutral, green trend. There was no red trend, not once this year. So if you've got my multi-trend as part of this class, then you know, oh gosh, Rog, when I put this on the daily, we never went red, right? Never once did this multi-trend go red, suggesting we were in a downtrend. So it's really looking at not just the macroeconomics of the market is accepted that the Fed is going to hike rates. Hiking rates does not mean we're going to keep sinking because yields are going up, because the dollar's going up. That's happened all year long in equities. Look at the S&P. What's not bullish about the S&P? Those are the markers. So 305, those are the markers. I looked at my tools and I trusted them. I didn't try to get cute. I didn't try to fearmonger. I acknowledged the chop for what it was. I acknowledged the trend for what it was. Look at the span between June and August. Shorting in this window just means you hate your money. I don't hate my money. I know you all don't hate your money. So look at that multi-trend. Look at the lower row of colors, which I realize you can't see. Hang on. Now do you see it? I'm even going to take my big head off here. All right, there you go. Now do you see it, okay? See that? Look at that lower row, right? Look at that lower row. And ultimately what you have there is yellow, which is neutral, green, which is bullish. Never once did we have a red trend. Let me show you one other thing that we do in the mastery, okay? Take a look at that yellow trend. If you have an oscillating tool that you like, overbought, oversold tool, which do not use in a trend, gang. Please do not use oscillators and trends. How do you know it's a trend? Trend here, trend here, trend here. This yellow right through here, that's chop. Okay, what do I do in a chop? Look at this gorgeous right there. That's it, right? And then we know we were going to get a little toppy in here, right? There it is. Kind of chopped around a bit, bounced off the 200, right? Things went green in June through August, which is, by the way, gang, why July was such a great trading month. You didn't have to be good at anything to trade through June and August, right? Just buy, just stay long, let the market do what it's already doing. And what if you could say, well, Rob, if that's the best type of environment to trade, can't I just wait for symbols that are doing this green trend here in the multi? Yeah, absolutely. And that's really where the gem of trading is, acknowledging that your tools and your strategies are going to work differently, sometimes better, sometimes worse, depending on the underlying structure. That's your structure. That is your structure for the year. Never once did it make sense to be a bear. Maybe take advantage of mean reversions or retracements, maybe shorten the time frame. So you might say, Rog, yeah, why are you so adamant about shortening the time frame? This is a great time to be day trading. This was a great time to be day trading. This was a great time to be day trading. This is a great time to be day trading. This is a great time to be swing trading, right? Here's a great time to swing trade. Here's a great time to swing, meaning overnight exposure, expecting longer term follow through. Now, do you see how you can step back and ask yourself, oh, the environment that the larger picture chart is in is going to help me with which strategy, time horizon do I use? Gang, that is it right there. You know, if you kind of absorbed what I just walked through in those last few minutes, you are going to absolutely move the needle in a huge way in your trading. And I know, I'm sorry I kind of dove into that so much. I know there's other questions I did not get to, but if you're seeing the value in that alone, right, and you can see how it panned out throughout the year. I'm not saying this is what I did. I'm showing you why, right? You can see that. I can see that. Now you know why short-term day trading to day trading is so important right now. We're stuck in a range. Thank you, automated support and resistance of Darvis, right? We're stuck in a range. Why would I expect behavior like this? Now, you're right, we wouldn't. So I hope that resonates. Really important. Really, really important. All right, gang. So that's it. I'm out of time. I'm going to jump on into the mastery. If that was the least bit interesting and appealing, please check out the class. If it wasn't, hey, no problem. I totally get it. So check out the class. Day trading is not only timely, it's timeless. You need this gear. Notice how often we were able to shift in and out of that gear throughout the year. And then once you join the class, gang, you're going to get exposure to my mastery, where I will teach you more about swing trading, the position portfolio, and all the other things that I do to keep my pipeline of opportunities full. Really excited about this, gang. This is going to be a workshop class. A lot of folks ask, Rob, what are you doing at 9:30? And what are you doing at 9:45? And what are we looking at 10 o'clock? The way Trish is breaking down this class is almost like an episode of 24, right? That whole season is one day. That's what we're really going to be doing in the class. What do we do during the day? Chronologically, what are we doing and thinking and doing and thinking, and what tools are we using throughout the day? So I think a lot of you that say, Rog, I want to know what you're doing at 9:42. We're going to walk you through how the day goes, how we enter orders, how we find the trades. Really excited about this. Very workshop oriented class, and I'm stoked for it. Gang, I'll see you tomorrow, 1 p.m. Enjoy the rest of your day. We do have bar coming up today, FOMC member bar. Sector Secrets Mastery, folks. I'll see you in just a moment.